This has been fascinating. I enjoyed this episode tremendously. Lots of fun reading questions from the viewers. Again, please feel free to submit
Yeah,
questions to either
yeah,
myself or
yeah. The
sorry.
viewer, yeah, the viewers' questions. This is the way to go. You, you must get these viewers engaged because number one, you read a bunch of questions. I thought they were all high quality,
Yeah.
excellent.
Welcome back to another episode with Professor Steve Hanke. He is a professor of applied economics at Johns Hopkins University and a globally renowned economist who is famous for his stance on monetary policy and his research on currencies. Welcome back to the show, Professor. We have you on every 2 weeks. Today, we'll be talking about not just your outlook, updated outlook on inflation and the economy, but we'll be addressing some of our viewers' questions that have been submitted to us, as well as talking about your misery index that was just released. So welcome back. Great show we have ahead of us today.
Great to be with you, David.
And to the viewers watching this right now, we do this every 2 weeks with Professor Hanke. Submit to us your questions. My email is down in the description below. Professor Hanke's email is also down in the description. Stay tuned also for a word from our sponsor, NordVPN. On this show, we regularly cover how to grow and protect your assets, but one of your most important assets is your privacy. Every investor needs to protect their digital privacy and footprint against hackers and potential viruses. According to Chainalysis, 2022 was the biggest year ever for crypto hacking, with hackers stealing $3.8 billion in cryptocurrency. And according to Duke University, more than 80% of US companies claim to have been successfully hacked. One of the best ways to protect yourself and your privacy online is with NordVPN. Not only does NordVPN hide your identity online from malicious actors and criminals, but it also comes equipped with malware protection. NordVPN also prevents you from accessing dangerous websites, allowing you to enjoy your favorite financial content securely. And the best part is that it is easy to use. Just download and click. NordVPN is available for your phone or computer, and they're currently offering 65% off on a 2-year plan plus 4 extra months. Simply click on nordvpn.com/David Lin in the description down below to learn more. But first, Professor Hanke, let's get into this week's inflation report, slightly hotter than expected. My first question to you is whether or not you still think inflation is going to come down below 3% this year, given that it's been sticky above 3% for quite a few months now. 3.2% was the latest headline CPI reading, which is slightly higher than the previous month's 3.1%. And of course, the CME Fed Watch tool is now pricing in pretty much no chance of a rate cut by next week. So what is your outlook on inflation? Has it changed since this month's report came out?
No.
No, okay. But so why is it taking so long to reach lower levels?
Okay, I thought you'd ask the why question.
Yeah.
It's my view has not changed because what the course of inflation and economic activity as well as asset prices is all determined by what happened to changes in the money supply a long time ago, maybe a year and a half, 2 years ago. So that's all water under the bridge, the change in the money supply, and it goes through a long and variable lag, a transmission mechanism into the economy before it starts affecting economic activity and inflation. So it's going down, and John Greenwood and I, who use the quantity theory of money to analyze these kinds of things, think that by the end of the year it'll be down to 2% or less.
Or less. Okay.
Or
There's
less, 2% or less.
well, certainly the Fed doesn't see it that way, at least not immediately. Otherwise, they would have, I guess, telegraphed a cut sooner.
The Fed doesn't see it that way at all because they don't look at the money supply. They have no idea what they're doing. They're actually hyper data dependent. They look at the data that are coming out day after day, hour after hour. That's what they're focused on. They're not focused on changes in the money supply that cause everything to change and drive everything. The fuel for the economy is the money supply. and they're not looking at that. And given these long and variable lags between changes in the money supply and changes in economic activity and inflation, they're just out to lunch because they're data dependent. They're looking at today's data. But what caused today's data to change around are things that happened a long time ago with the money supply. So as a result, in a way, they're really just flying blind. So their view, I can tell you what it is. They look at these last 2 months worth of data. We have inflation at 3.1%. Then it jumped up a little bit to 3.2%. And their conclusion is inflation's sticky, it's sticking around. We got to stay tight. We're not going to reduce the Fed funds rate and loosen up anytime soon. And that's what the market thinks too, by the way. The market doesn't think there's much of a chance of any change in the Fed funds rate until the June meeting of the Federal Open Market Committee.
Someone told me the other day the Fed is probably just going to revise their inflation target to 3% because it's unlikely going to come down below 3%. That's his view. So the Fed's just gonna, change the rules, so to speak, and be done with it.
Well, this is somebody that's talking in a classroom, kind of. This is hypothetical BS. They're not going to change they're not going to change their target. Can you imagine if they would? They'd get creamed by the public. The public would completely lose trust in the Fed if they said, "Oh, relax. We're going from 2% target to 3% target."
Remember, though, a couple of years ago, they changed it to an average of 2%. Remember that happened?
Yeah, they had a lot of mishmash and that was going on, but at the end of the day, the target was what? 2.
Yeah. Okay.
Nothing really ever changed. At
I,
least nothing changed in the public's mind. And that's what we're talking about here. If public trust and confidence in the Fed is dictated by obviously what the Fed is doing. Now, the Fed, if people were actually paying attention to things, there'd be no trust in the Fed because we've been on a huge roller coaster ride since the pandemic. Remember, February 2021, the money supply was going up at 27% year over year. That's about 4 times higher than Hanke's golden growth rate of 6%, which would be consistent with hitting a 2% inflation target. Then what happened? Then the roller coaster goes up to 27%, and boom, it's going down. I mean, now the year over year rate of growth in the money supply is negative about 2%. So up and then down. And what's happened to inflation? Up and then down. So people, if they were paying attention to the relationship between changes in the money supply and inflation, the Fed would have no public trust, no public confidence at all. But they've been able to con the public. The Fed has said, oh, the reason we had inflation was because we had supply chain glitches and we had Russia invading Ukraine, and that increased the oil prices for a while and grain prices and whatnot. And now, kind of ironically, they so conned the public and the press, the Fed. Now they're patting themselves on their back and they say, we got it wrong. The supply chain thing has been fixed. Oil prices aren't that high. That's calmed down. Commodity prices are actually have been going down. And all those factors are bringing inflation down. And oh, by the way, we did a great job by increasing the Fed funds rate too and introducing quantitative tightening. So we had a positive role to play in all this. So the Fed comes out smelling like a rose.
Right. Okay. I would like to get to some viewers' questions.
And of course the public has no
Sure.
idea what's going on. They've been bamboozled completely bamboozled.
Okay. Actually, we've got quite a few questions on the money supply. Here's one of them from Chris Cleary from Seattle. So thank you, Chris, for your submission. Is there any benefit in following the real M2 money supply in addition to the M2 money supply? I ask this because I noticed the real M2 is more sensitive to trends, both negative and positive, when comparing year-over-year percentage changes. For example, real M2 turned negative in April 2022, while M2 turned negative in December 2022. Many thanks.
Well, actually, the real rate, if it turned negative in April, in March, in March, the nominal turned. So there really isn't that much difference. No, the answer to this is no. It's the quantity theory of money and the equation of exchange. It's easier to use that in nominal terms, because nominal, what are we doing with the quantity theory of money? We've got MV equals PY. That's the equation of exchange. M is the money supply, V is its velocity, and that's equal to P, the price level, plus Y, and Y is the real change in economic activity. Now, that right-hand side of the equation, that's nominal GDP. That's what you want to look at. P is inflation, Y is the real rate of growth in the economy. You put both of those together and you've got nominal GDP, and you just use nominal numbers. It's much, number one, it's much simpler. The quantity theory of money is a model for national income determination, and national income determination in nominal terms, where you include inflation. Because the thing that's really moving around all the time on the right-hand side of that equation, in the long run, it isn't Y. In the intermediate and long run, Y is staying pretty stable. It's P that goes up and down, the inflation. So the answer to that is you can work out and you get the same answer by using an inflation-adjusted real measure for M2 or money supply, whatever the measure of metric you're using for money supply. You can do it in real terms, but you'll fundamentally get the same answer that if you use nominal terms, and nominal is a lot easier to use.
This one's a pretty good question, Professor, from Charles Law. He said, how can the money supply be shrinking with high federal budget deficits? Why are U.S. treasuries not counted in M2? And then he provides an example. He says, U.S. treasuries are loans to the government. The government is spending that money. U.S. treasuries are counted on balance sheets and are collateral. They are as good as money. If you count treasuries in M2, then it grew by about 6% in 2023.
Well, number one, treasuries aren't money. Since when can you go in and spend a treasury? Money are things that notes and coins are money. About 11% of M2 is made up of notes and coins, and about 76% of M2 is made up of deposits at bank, liquid bank deposits that you can write a check on. That means you can spend it, and then you've got about 5%. If my memory serves me right, about 5% are short-term savings deposits. So they're pretty liquid. That's included in M2, and the remainder is retail money market accounts, and you can spend those too. So that's the reason it's not counted in M2. Now, it is counted. If you go at the Center for Financial Stability's website, you'll find broader measures that go out to M3 and even M4. Now, M4 does include treasuries, but the weight on those is not 100% because you can't spend them right away. You've got to convert them into something that's spendable. So there's a lighter weight on those treasuries that are included in what's called divisia measures. And and Division Majors M4 does include treasuries. Now, down to the deficit, because the question has a lot of stuff mixed into it. The deficit does not affect the money supply unless the Federal Reserve buys the treasuries that are being emitted and credits the account of the seller. So if the Fed is not buying any of the treasuries that are emitted, the money supply doesn't change.
I understand. Okay, so it's a clarification on the terminologies you used. All right, we have a few more questions. They're pretty good on your outlook here. This one it has to do with the Fed. Says, per your post on X, wondering if you could ask Professor Hanke's take on how many cuts the Fed might do, if any, this year, with recent retail sales and PPI data released today, March 14th. Retail sales were up, picked up a little bit. Retail sales rose by 0.6% last month after falling a revised 1.1%. So,
if
I
you
mean,
look
it's
at the Fed,
slower than, yeah.
if you look at the Fed funds market now, the probability of the Fed even starting to increase Fed funds, it goes back into, sometime June or later. So that's
Okay.
one point. The other thing on retail sales, he did bring up retail sales, and this gets into my view about where the economy is headed. It's headed probably for a recession late in the year, and you're starting to pick up weakness in the labor market. And also, if you look at inflation adjusted retail sales, they've actually been negative year over year for 12 out of the last 16 months. So again, adjusted for inflation, retail sales are going down.
Yeah.
They're getting weaker.
That's correct. Yeah, if you take a look at the percentage change adjusted for inflation, it would be negative. Okay, so on that note, there's another question that came in about how many Fed cuts might be implemented this year. This one says, according to a recent article, it seems that some strategists may be speculating that the Bitcoin's price surge may delay rate cuts from the Fed. Is this possible? We spoke offline about this, but I'll just read for the audience a paragraph from this article from Yahoo Finance. It says here, Bitcoin's recent price surge to new highs has some experts worried, including JP Morgan Chase's chief market strategist, Marco Kolanovich. In a research note, Kolanovich reportedly expressed concern that the rally in Bitcoin and other digital assets could hinder the Federal Reserve's ability to loosen monetary policy. He argues that Bitcoin's jump above $60,000 may keep monetary policy higher for longer. His reasoning is that premature interest rate cuts could further inflate asset prices or reignite inflation. What's your response to this, Professor?
Well, this is the kind of thing you get out of the investment banks. These reports, it's utter nonsense. I mean, they just make this stuff up.
Okay.
The Fed, believe me, it isn't going to be changing course because of the changes in the price of Bitcoin, a speculative asset. And if you follow this line of argument, you could make a case that there's a wealth effect associated with a price increase in an asset,
Mm-hmm.
an asset class. So the price goes up by 300% or whatever. Bitcoin has gone up. Now it's over $70,000. I haven't looked lately. It's not 60,000.
Right.
It broke. It's made new highs and it's up, a lot. Consistent with my view, I've always said Bitcoin's nothing more than a highly speculative asset.
Well, that's a good point you bring up, Professor. Suppose you have all assets inflate, not just Bitcoin, but stocks, gold. Suppose everything goes up in nominal terms. Does that mean that the money supply indirectly could expand if people just have more wealth to spend?
No. Well, this gets into something called the permanent income. I was leading into.
Okay.
and you outlined it a little bit better. To okay, you have let's say a class. Let's leave it to Bitcoin. You have a
Okay.
class of assets, the value goes way up. So there is a wealth effect. Those people who've invested in Bitcoin have more wealth than they had before. But you have to look at it in terms of the permanent income hypothesis. Do they think this is going to be a permanent increase in wealth? And if they do, maybe they'll change their spending patterns. And that will affect what? It'll affect the real economic activity in the economy. And that everything is connected to everything else. So that would be the case. But what if they don't view this as being a permanent increase in their wealth? Then they won't change anything, given the permanent income hypothesis. So there are a lot of ifs in the picture, and you have to remember, Bitcoin's is pretty small potatoes anyway.
Right.
You're talking about, in fact, in the broader scheme of things, even this huge increase in value is a very tiny thing in overall aggregate balance sheets in the United States or the world. It's hardly a footnote. It's a think thing. So even if people thought it was going to be permanent, it wouldn't have much of an effect really on real economic activity. So I think the note, they basically write fiction, these investment bank reports. They're required to write a report every day. They got some young person in there that's maybe below 30 years of age who can hardly find their office door, let alone write something intelligent. So it's a hypothesis. It takes somebody like me 2 seconds to take it apart and put it in the trash.
Okay, hold up. It leads to a broader question. Have you observed any direct relationship between asset prices increasing and higher consumer prices? In other words, in your many years of research, have you noticed the markets going up and CPI going up because of those assets going up?
Yeah, absolutely. But it starts. You have to start with the quantity theory of money.
Okay.
Those are the effects of changes in the money supply.
Right.
If you have a substantial increase in the money supply, the next thing that happens within 6 to 18 months is that asset prices go up. Why do you think real estate jumped up after the pandemic started and we started turning out money?
Right.
So and why do you think the S&P skyrocketed? It was because the money supply went up. So absolutely, that's the way the system works. But you have to start at the beginning, and the beginning is always changes in the money supply. Then you go through the transmission mechanism, changes in asset prices. Then the next thing with a little longer lag, changes in economic activity. Then ultimately, changes in the price level.
Okay, that's an excellent point that leads to my next question, the viewer's next question, which is why the money supply has been shrinking and asset prices like stocks have been rising. This person's question summarized it better than I could. He says, my question to Professor Hanke is, globally, we are seeing tight liquidity and high interest rates, yet world markets, except China, are at all-time highs. So are gold and Bitcoin. What is fueling this rally? And second, what will it take for investors to be risk averse rather than risk takers? Warm regards from Nikunj Vira from India.
Okay, Nikun, this is a good point. So if you look at current data, of course, these asset prices are going up. Now, why have they been going up? Because in fact, what happened after the pandemic started, you had this huge increase in money and the cash balances people had. If you take M2 and divide it by GDP, that's the cash balance. Okay, M2, the money to any measure of the money supply over GDP. And you get that ratio of cash to real economic activity. And that went up. There was a huge excess. And that excess, of course, once people see, oh, we have a lot more money than we would prefer to have. What do? They spend it by buying assets. That's the asset price increase. And now that excess has been essentially all drained off. And now the excess tank is kind of empty. And what happens then with the negative growth in the money supply? We're going to eventually see a slowdown in economic activity. We're seeing starts of it already. Slowdown in free cash flow, slowdown in profits. The market starts coming down as we go into a recession, and the multiples will come down. And when that happens, the bloom will come off the lily in the market.
So the recession and
it's
slower
coming.
multiples will trigger a sell-off. That's what will make investors less risk averse, or more risk averse. More risk averse.
They'll become more risk on. And in anticipation of that, you are getting this in the gold market. The gold market always does very well before and during the early phases of a recession.
Okay.
Plus the fact central banks have been buying gold like mad, especially in places like Russia and China. And the reason for that is the fact that the U.S. has stupidly weaponized the U.S. dollar and the U.S. dollar financial system by imposing sanctions on everything that moves. So the U.S. is engaged in a very stupid policy of sanctioning everything that moves. And that makes the dollar more vulnerable, and people want to substitute and get out of it. Now, we don't see dollar weakness yet, by the way. The dollar actually is very strong. If you look at the dollar euro exchange rate, I think the fair value is about 120 to 140. And it's been riding in there around 108, 109 for a long time. The dollar euro exchange rate, very strong dollar for a long time. So gold usually doesn't do that well in a strong dollar environment. It's doing well now, and the main reason is central bank buying, in my view.
Mm-hmm.
It's not the retail small guy buying. It's the central banks buying big time.
A few more, and I want to talk about your misery index. Very interesting. This is a question from a Chinese viewer. I am curious about Professor Hanke's view on the deflation in China. Is it true, and why? What are its implications to the Chinese economy and equity markets, downstream impact on the global commerce, and China's geopolitical position?
Well, that's a great question. The Chinese monetary policy, first of all, why is what's the main thing that's driven this decline in prices? Now the price increase, the CPI is slightly positive in China, but they've had 2 or 3 negative months where it actually was deflating.
Yes.
And that is because the inflation target in China is 3%. So obviously the realized inflation rates are lower than the target. And that's because the money supply, broadly measured, has been growing a little below Hanke's golden growth rate that would be consistent with hitting the 3% target. So in fact, the central bank is just being too tight. Not a lot, but a little bit too tight. I think they should be loosening up a little bit. And if they did, the headline CPI numbers would come up gradually and get a little closer to the target.
Let's talk about Argentina and then your misery index. Before we talk about the misery index, just some recent statistical updates from Argentina. So Argentina's statistics agency is due to publish February inflation figures on Tuesday. Well, I guess it already did. This was earlier this
Well,
week.
they already did. They
Yeah,
already did. It jumped up to 276.2% year over year.
but on a month-to-month basis, it's cooling down, right?
Month to month came down, but the year over year shot up. When President Milei took office on December 10th, the inflation rate was 211.4% year over year. Now it's 276.2%.
Okay. The central bank also cut rates from 100% to 80%. Does it look like things are on the right track? Is Milei actually successful, if you want to use that term, in combating inflation for
Oh
now?
no, things are completely on the wrong track. Milei ran on the campaign that he was going to get rid of the central bank. He was going to get rid of the peso and dollarize officially the economy, replace the peso with the
Yes.
US. If he would have done that, the inflation numbers would be, approaching inflation in the United States within about 30 days after he would have done that. So if he would have done it in December, the inflation would have probably be, year over year, probably in single digits already. Right. So he completely missed the boat by shelving dollarization, and he claimed that it wasn't feasible. His advisors have been giving him bad advice. They say it isn't feasible because the central bank has negative net foreign reserves.
Well, why are they lowering rates even if inflation is still relatively high? Why do they lower their central bank policy rate from 100% to 80%?
You'll have to ask them. Who knows why?
Okay.
Who knows why they lowered the rate? They're doing everything wrong, basically. They're following the standard IMF package, austerity package, which has failed in country after country, and in Argentina, it's failed big time, over and over again. That's why right now Argentina is in hock to the IMF for $44 billion. It's the largest IMF credit outstanding in the world, and that's because Argentina is a recidivist. It comes back over and over and over and over again, and it comes back because they have a peso and they have a central bank. And end of story.
Okay.
They did, by the way, they did a big peso debt swap also when they reduced interest rates. You didn't mention that. They wanted to extend the life of these peso debts out to about 4 years. That didn't work out very well. S&P downgraded them into default almost immediately.
Right.
So it's just been one stumbling step of the blind leading the blind in Argentina ever since Milei was elected. And it's all because he didn't follow through on his promise to dollarize. And they could have. It was feasible. I've analyzed this thing very carefully. And you don't need net foreign reserves to be positive to dollarize. All you need is gross reserves, liquid reserves, large enough to swap out the notes and coins and pesos outstanding at whatever exchange rate you determine. Swap those out for US dollars, and they have enough gross reserves to do that. Plenty. And I know this. We're not talking academic here or accounting theory or anything, David. I did this in Ecuador. They had negative net foreign reserves in 2000, but they had gross reserves that were in excess of the outstanding sucre notes and coins that were floating around in Ecuador. And we did the dollarization. So the proof of the pudding is in the eating. These people aren't even looking at real world experience. And by the way, let me emphasize, when I talk about these currency reforms, I'm not in a classroom BSing somebody. I've done it, and it goes from, in two cases, dollarization, I was a state counselor and chief economic advisor to Milo Djukanovic in Montenegro, and we replaced the hyperinflating Yugoslav dinar with a German mark in 1999. I did it. I designed. I wrote the book with Jacob Bogatic, and I wrote the book on it, published in Serbo-Croatian. If somebody can read Serbo-Croatian, they can read that book.
Oh, you know what? I want to talk about this next time. If you have any more questions for Professor Hanke, submit them in the emails down below. We're gonna do more episodes on a lot of different economic concepts. So whatever questions you may have, hyperinflation, Professor Hanke was just alluding to, we can talk about that. We can talk about world history, upcoming elections, anything. Professor Hanke is very knowledgeable in pretty much anything we can talk about. All right, I want to finish up the segment with talking about your misery index. Here you tweeted that in Hanke's 2023 annual misery index, Argentina has replaced Zimbabwe as the most miserable country in the world. I'm going to show this table that you've tweeted here. You've got the unemployment rate at 6.5%, inflation rate at above 200%, bank lending rate at 95.9%, real GDP per capita growth negative 1.5%, and your misery index score at 321.8%. Not percent, but just the score, 321.8. Major contributing factor to this misery is inflation. I'm curious as to how the score is calculated, Professor, before we move on.
Okay, here's what this thing started with. Our Art Oken was a very distinguished economist, a professor at Yale, chairman of the President's Council of Economic Advisors under President Johnson back in the 70s. And the original Oken misery index was that inflation plus unemployment. If you add those two things, you get a misery index score. Then Robert Barrow at Harvard revised that once, and then I've revised it 2 times. And my misery index, the Hanke misery index, is the unemployment rate times 2. You give it a weight, you give it a double weight. Then you add inflation, then you add bank lending rate. Those are 3 miserable things: high unemployment, high inflation, high bank lending rates, and those are all negative, all bad. And then you can subtract one good thing, and that is if GDP per capita, if your income's going up, that's good. So you can subtract that from those 3 bads, and that gives you the misery index. And Argentina is this year's most miserable country. We just released an article I wrote in National Review, and my column in National Review this week goes through the whole thing in detail.
Yeah.
Argentina is the most miserable. Then we have Venezuela, Lebanon, Syria, Zimbabwe, Sudan. Turkey is number 7, Tonga, Yemen, and South Africa. Those are the top 10. Iran is number 11. So those are all miserable. Now, if we go down, we have 157 countries, David. If we go down to the ones that are least miserable, the most happy ones, let's look at the top 6 least miserable: Thailand, Japan, Switzerland, Qatar, Malta, China. China comes in there. It's the 6th least miserable country. So it's doing pretty well.
Yeah.
It
So you're
ranks
factoring this solely on economic factors. Okay.
152. The U.S. is quite a bit more miserable than China. It's 132.
I mean that look, I okay. I mean, I don't have you talked to people from the average man from China versus the average man from the US and see who's happier? I don't know.
I haven't talked to him, but this is the misery index. The great thing about it, and actually President Johnson was the one who grabbed onto this with Art Oken when Oken was the president's chief economic advisor, and Johnson kept saying all this economic data, it's so complicated. He said, how are people feeling? What's an easy way for me to keep track of this?
Yeah.
And Oken said, oh, the misery index. Just unemployment plus inflation. Add those two things together and you'll get a pretty good idea. So these are just objective numbers. I haven't interviewed somebody. I'm not a psychologist or a psychiatrist. I haven't gotten a Chinaman on the couch and investigated how they're feeling. From everything I read from the propaganda, by the way, because the US, you have to remember, now we're in this mode, China is an enemy. So if you read the US press, they're going to be dumping on China. So nothing can be good coming out of China.
Okay, I'm just curious as to there's many different happiness indices around the world. The World Economic Forum publishes one. Actually, in their bottom of the list, Zimbabwe is also there, so there's some alignment there. But they're also factoring in things like freedom of oppression, freedom of speech, lifestyle metrics.
Well, there are a lot of ones out there. The Hanke Misery Index is based off revisions and evolution of the original. Okay. So it's got originality. It's also got plain vanilla. It's also easy to replicate by data that are readily available. All these data for unemployment, inflation, bank lending rates, GDP per capita, they all come from the same place.
Right.
So I'm not cherry picking stuff around. And so I would argue that if you really want an objective measure, you go with Hanke's Misery Index.
But would you consider adding to this metric things like civil liberties and freedom of speech and oppression from the state, so on and so forth?
They already do that. And the Cato Institute puts out, for example, an annual human freedom index that I use. But it's a much broader thing. It includes all these civil liberties and everything under the sun: safety, security, religious freedom, all kinds of things are in there. This is a simple, objective, plain vanilla measure of misery.
Right. Okay.
Nothing more. And as a result, by the way, simplicity is golden. If you get caught in a spider web of complexity, you end up doing what? You get stung by the spider.
Okay. No, we wouldn't want that now, would we? All right. So this misery index has been published. What do we do with this information? I think people looking at this table,
you get do what President Johnson did. Are things getting worse or getting better? If I was a politician in Argentina, I'd say, if I don't get this thing down, and by the way, 95% of the score for Argentina, the most miserable country in the world, is made up of two things: inflation and bank lending rates. And those are very related to each other. Bank lending rates are very much geared to inflation. So you've got 95% of the misery in Hanke's Misery Index on Argentina, all revolving around inflation. So I'd want to get that. If I was a President Milei, I'd want to crush that inflation number as fast as I possibly could. And if he doesn't, he's toast. And the only way to do it is do what he promised to do during the campaign: get rid of the peso and dollarize.
Why is the bank lending rate relevant to most people in these developing countries who probably don't even have a credit card or any debt? And when you think about it, what relevance does that have for the average person? The other factors I understand.
Well, you're saying that the average person doesn't borrow money?
Well, I don't know if they even have credit to borrow money. Most people don't even have a bank account in some developing countries.
Number one, I don't think that's actually true, but that's okay. What the crypto people like to tell you that,
okay.
No one's being banked. And if you have crypto, you can end up getting
okay,
banked.
fair enough.
That's you've been taken in with a little propaganda there, but at any rate, that happens once in a while.
Okay.
Credit is always extended, because even if you don't have a bank account, what happens? You go to your mother or father or your grandparents and you borrow some money from them.
Right.
And what interest do they charge? It's going to be somehow geared to what the bank lending rate is, unless they just give you a gift. But if you actually borrow money from them, you're going to be charged interest. You got to pay grandpa back more than grandpa gave you, and that will be determined by what the interest rate is that grandpa decides to charge you.
Okay, fair enough. This has been fascinating. I enjoyed this episode tremendously. Lots of fun reading questions from the viewers. Again, please feel free to submit questions to either myself or
the viewers' questions. This is the way to go. You must get these viewers engaged, because number one, you read a bunch of questions. I thought they were all high quality, excellent. Who knows? Maybe you filtered them. I have no idea, but they were all good, and I enjoyed answering them. I hope I was clear enough in my response.
Good, yeah.
But this you have to respond to what on all these things. The key, when you're giving a speech, for example, you have to anticipate, what does the audience want to hear? What are their questions?
Right.
And this is a perfect way to do it.
No, absolutely. So again, submit your questions to myself or Professor Hanke. Both of our emails are in the description. I'll put them down. Professor Hanke can also be followed on Twitter. I'll put his Twitter handle in the description as well. So please follow him and write to Professor Hanke directly. Thank you again. We appreciate your time. Thank you to the viewers for submitting questions. We'll do this again in 2 weeks.
Thank you, David.
All right. Have a great weekend. Take care. Bye-bye.